Today, folks, we're going to talk about Bell. This stock is getting absolutely wrecked today on its earnings and is by far one of the highest yielding Canadian dividend stocks that currently exist out there. I mean, you take a look at the stock price, just today alone is now down 4.5% with a 7.63% starting dividend yield. The further you zoom out, the worse this begins to look. Year to date, this thing's down almost 6%. We have to zoom way out past the 5-year to see that this stock is now trading at levels that it basically hasn't really seen since 2015. I mean, we're talking about almost knocking out a decade worth of returns, but most people are buying this for the dividends. We got to ask ourselves, is this dividend going to continue to be stable, reliable? And if that is a conversation you'd appreciate, damn it, hit that like button, because again, the rarity of the dividend being this high is unforeseen throughout Bell's entire history, as far as I can tell. I mean, let's go back all the way to the 90s. I don't know what happened here where the dividend hit 300%. Keep in mind, this is probably on the US ticker, so let's presume some anomalies, get those out of the way. But never in Bell's history have we ever seen yields this high. This is a conclusion to so many of the Canadian conglomerates out there right now, from the banks to some of the utilities. And I just think it's one of these unique opportunities where if you are heading into retirement, or even like myself, as I'm looking to buy back a lot of these Canadian stocks, especially the banks, heading into earnings, because I think there's some potential there. We'll talk about it in another video. You can subscribe for those updates. But what is wrecking Bell right now? Well, you're going to see a lot of headlines because this company is reducing their workforce by 4,800 people in 2024, and including the elimination of 750 contractors. I mean, we're still talking about job layoffs across the board, and it's not that Bell can't afford these jobs. As mentioned, shareholders matter more than employees. We're going to talk about what's driving that, but that's 9% of their total employees, man. I mean, this is the largest workforce restructuring initiative in nearly 30 years, and all the way they call it restructuring, it's just, hey, we don't need you. We're going to get rid of you. They're basically going to yield an extra 150 to 200 million of cost savings in 2024, 250 million annualized. And this really just comes down to the higher interest rate environment. But you're going to see headlines like this. BCE does massive layoffs and the sale of 45 radio stations. Like, they've been really focused on the media side of their business, because we know media probably not as profitable as it once been. And what they said is that the weekday noon newscasts at all CTV stations except Toronto would end. It is also scraping at 6 p.m. and 11 p.m. newscasts on weekends at all CTV and CTV2 stations except Toronto, Montreal, and Ottawa. And I used to watch CTV, you know, Dave Duvall growing up. My parents would always watch The Weather Guy. All that is kind of come and gone. The news is prehistoric at this point. They can't compete with social media. And man, oh man, Bell is, if you worked at any of these CTV news stations, I bet you're just trembling right now, because God knows that's going to be a huge part of these layoffs, right? So just something to pay attention to. But when it really comes down to the bread and butter, the numbers, what's going on here? And the numbers are pretty good for an old dinosaur-like business here, considering, again, it's subscription-based revenue. It's usually relatively stable and reliable. And we can actually see that if you take a look at their total operating revenue here, pretty good, 6.47 billion. You know, it's up from Q4 of 2022 just a bit. It's mostly flat, 6.439 billion in Q4 of 2022, whereas this is 6.473 billion. Annually, not much. I mean, you're talking about what, a 500, it's a 2.1% increase in change year over year. That's not bad. Again, we're talking about a conglomerate that people are buying for dividends. This is what I would call stable. But what is unstable about this balance sheet? Oh, baby, we got to talk about the interest expenses, right? That interest expense came at $399 million, which is up from $319 million this time in 2022. This is insane, because they're paying $1.47 billion just in interest over the entirety of 2023, which is up 28% year over year. This is what is causing the layoffs. This is largely going to be temporary until we head into an interest rate cut cycle. This is the window of opportunity for those of you in retirement, or those of you looking into high or getting into high yields, but maybe you're a little concerned. This is not financial advice, but you might be asking yourself, can they afford the dividend of 96 cents? Because that's what they're paying, which is up from 92 cents basically in Q4 of 2022. Like, the dividend increase has been pretty nice, right? But the problem is their earnings were only 42 cents per share, but they're paying out 96 cents. So if you go on, everyone's going to be like, oh, they can't afford the dividend, don't buy it. It's a trap. It's a trap. Run. I'm giving myself the hiccups here. But the reality is that they're paying the dividend through the amortization and depreciation cost, right? I mean, you take a look and they depreciated 3.7 billion and amortized about 1.1 billion. I mean, these amortization and depreciation costs don't directly affect the cash flow. They just don't end up in net income because the government considers them a write down against their assets that are losing value. So they get to keep some of that extra cash flow. It just doesn't get added to the net income because it's like, well, you spent money in the past on building up infrastructure, its value's gone down, so we'll write that value loss against that big cash pile you currently have. So it just doesn't show up in that net income, that EPS that you see right here, right? So they can definitely afford the dividend, which is why they've been announcing that they're increasing the dividend by 3.1% increase in 2024, and that is not massive. I mean, this is a massive slowdown from their prior dividend increases, right? You take a look through history. From a decade ago, they were paying 62 cents. Today, 97. That's not crazy. It's really nice for the high yield that you're currently getting, but when we really zoom out, basically from, I'm going to say, about 2007, 2008, with the exception of the financial crisis here. I wonder if they cut their dividend through that period because it's not showing a dividend. But either way, from 2010 roughly onwards, I mean, just like the rest of the economy, we were in one of the greatest growth periods ever. I mean, things were just consistent. Markets were great. Interest rates were low. We were la-di-da. But you can start seeing this leveling off happening here, and that's probably going to persist. I mean, until we get into interest rate cuts, there's no reason to like really increase the dividends, which we can see here. The current BCE share price and dividend yield, not reflective of higher dividend growth, and balances capital allocation priorities and provides financial flexibility, giving higher rate environment, significant workforce restructuring program, and the acceleration of transformative initiatives, which is great because, this is not great, but I mean, it's the reality of being a shareholder is better than being an employee because, hey, you're going to get a raise as a shareholder this year. It's only 3%, but my God, that's better than the thousands of people they're laying off. Isn't that funny how that works? Hey guys, we're going to give you a raise, but we fire a ton of people. I mean, you got to love the investing world, right? It's very odd. But anyways, that kind of accumulates to a 12% increase 12-cent increase for 2024 to a total of $3.99 per share, which again, in contrast to what they currently paid this last year, which was $3.87. So nothing dramatic by any metric. And that was an increase of about 5.2% on a year-over-year basis. So we're slowly decreasing the dividend growth rate. And that is just what you have to anticipate in a market like this. But again, lower dividend growth rate, but record insane high starting dividend yields, which is why you should be a buyer in this market. But all in all, I mean, things are pretty good. They maintain stable year-over-year adjusted EBITDA margins of 42.2%. I mean, they've been doing what they need to be doing. They're expanding 5G, baby. Fiber optics are coming like crazy. 650,000 new locations. Infrastructure's growing. So ain't nobody complaining here. It's just the dividend, right? But all in all, for the market environment we're in, la-di-da, I don't think this is that bad unless you're working for the company, especially if you're working at CTV, somewhere that's not in Toronto. Again, I'm sorry. It's a shame of reality of these markets. Everyone's job can be kind of at risk here. And what does that mean for the rest of the telecom giants? Well, fear and uncertainty, baby. That is the market we now exist in, as TELUS is dropping 2% just on Bell's news. I think we're getting TELUS's earnings in the next couple of days or so. I'll have to keep an eye out. We'll do a video for that, so subscribe for those updates. TELUS is probably my favorite telecom giant, now paying 6.58%, and Rogers here, getting hit as well. Not as badly, but this is the reality of telecom giants today, folks. But I'll pass the question off to you. Are you buying these? What do you think about telecom? And what do you think is going on with the Canadian economy? I'd love to hear about it in that comment section below.